Welcome, dear traders. Today, the main drivers of trading in the Asia-Pacific region were comments from policymakers. Meanwhile, markets have already forgotten one of them. We heard this statement almost every day last year, and now it has returned to the fundamental background. The second was about the outlook for the world's second economy. The third statement was one of the many that had been heard before, but it still had weight. Fed spokesman Raphael Bostic has said he does not see a rate cut before the third quarter of 2024. At the same time, he believes that this position could be reconsidered if there is a convincing evidence in the coming months that inflation is falling faster than he expected. In this regard, yesterday's US statistics raised mixed expectations. In the labor market, the unemployment rate fell and building permits rose. At the same time, indicators of manufacturing and business activity remained in a negative territory. In Philadelphia, the manufacturing activity index was recorded at minus 10.6 points. The reading was up from a minus 12.6 in December, but well below the forecast of a minus 7 points. The diffusion index for future general activity slumped to a negative 4 from a positive 12.6 points. Conflicting statistics amid numerous hawkish comments from Federal Reserve officials added to market doubts about the timing of rate cuts. In addition, US Treasury yields surged again on the back of the strong employment data. As a result, the US dollar index gained nearly 1% to 103.54 during a very volatile session yesterday. At the beginning of Friday, its price against 6 major counterparts were still under bearish pressure and went into the range of 103.30 and 103.50. Most likely, the main reason for the US currency's decline was Christine Lagarde's speech at the Davos Economic Forum. The head of the European Central Bank cooled investors' hopes that interest rates could be cut as early as March or April. The regulator's hawkish outlook pushed the euro higher, and the US dollar index was sent into a narrow flat, correcting near 103.40, taking into account that today the next batch of economic reports will be published in the United States, as well as the general bullish momentum of the US dollar. It's quite capable of testing the resistance levels of 103.60 and 104.00. The next technical support is located in the 103.00 and 102.70 area. The strengthening of the euro, which accounts for the impressive 57% of the US dollar basket, also affected the Japanese yen. As a result, the dollar-yen pair jumped to 148.80 and remained in the range of 147.90 and 148.80. For the first 3 weeks of January, the pair has already gained 5%. The next technical support level has moved higher to 147.6 on the chart. And today, if the US dollar repeats yesterday's roller coaster ride, the pair may return to the resistance area of 148.50 and 149. Today's surge in the dollar-yen pair forced the Japanese authorities to repeat a well-known statement. Japanese Finance Minister Shunichi Suzuki said that the government was closely monitoring currency movements and that the yen's exchange rate should reflect fundamental data. Judging by the yen's chart, it seems to have borne fruit. However, the reports on inflation rates may have also affected the Japanese yen, and the data showed a drop to 2.6%, and this is a good sign for the Bank of Japan as it's getting closer to its 2% target. However, wage increases in the country are not going as well. In addition, the economy needs to recover from the damage caused by the New Year's earthquake. Therefore, the Japanese regulator is likely to keep its ultra-loose policy unchanged at the next week's meeting. The Japanese authorities fear a return to the deflation that has harmed the country's economy for decades, and China's leaders seem to disregard such a threat to the economy. At least China's Premier Li Qiang said that Beijing would not use large-scale stimulus to improve economic performance. The Chinese government believed that such measures may lead to an accumulation of long-term risks. At the same time, statistics in recent weeks point to economic and demographic trends that could exacerbate these long-term problems. The precarious position of the world's second-largest economy is confirmed by the yuan's continued weakness against the US dollar's recovery. The Australian dollar has been wound down by the disappointing outlook for China and the weakness of the yuan. And today the Aussie rallied along with the other commodity currencies on the back of higher oil prices. The Australian currency soared to resistance at a 0.6590 from a support at a 0.6560 early Friday. With the Aussie dollar pair rallying along with the US dollar's correction, the Aussie may break through the 0.66 level and test the resistance level in the 0.6610 and 0.6650 area. If the US dollar strengthens, the pair may move toward yesterday's low of a 0.6560, support at 0.6530, or even the 0.65 mark. For the New Zealand dollar, disappointing news from China seems to be the main driver today. In addition, New Zealand has seen continued weakness in manufacturing activity. However, prices are still high, as is the interest rate. The recession, coupled with the inflation, is leading to currency depreciation. Weak demand from China is waning on the trade market. As a result, the kiwi was trading lower within a daily range of 0.6090 and 0.6130 today. However, the New Zealand currency attempted to strengthen as a commodity currency, returning above the key level of 0.61. Today, the trajectory of the Kiwi dollar pair will likely depend on the US dollar, and we may see the pair rise to the 0.6160 and 0.6200 resistance level, or fall back below 0.61 and test the support of 6080 and 0.6100. And that's all for now. Stay tuned for more updates with the InstaForex TV. We appreciate your feedback. Please leave your questions and comments below, and see you online soon.